Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Opendoor.
If you find our talks useful, please consider subscribe, like, and comment underneath the video.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10K with VIP indicators. VIP Indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10K is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose.
Yeah.
This is an affiliate link, so I may own a commission if you use it at no extra cost to you.
All right, let's jump right in, because today we're looking at this massive contradiction staring us right in the face.
Yeah, it really is quite the puzzle.
I mean, imagine you're looking at a real estate technology company.
Yeah.
Right. And they just reported a 38% drop in year-over-year revenue. On paper, that headline looks absolutely terrifying.
Oh, completely terrifying. Like you probably just run for the hills.
Right. Yet, if you look closer at that exact same company, they simultaneously beat Wall Street expectations. The stock has completely outpaced the S&P 500's monthly gains. And this is the crazy part. Insiders are buying up nearly $500,000 of shares on the open market with their own cash.
Which is wild. And, if you are trying to make sense of this for your own portfolio, you really have to look past those scary headline numbers.
Yeah.
Because what we are actually witnessing here is a fundamental shift in their core business model.
Okay, a shift from what to what, exactly?
Well, they are transitioning from essentially trying to predict home prices to leveraging AI for pure speed. Management is calling this Opendoor 2.0.
All right, let's move into the wealth building context. Because to understand where this company is going, we really need to understand what was broken in the first place.
Yeah, we have to look at the original business model, what we can call Opendoor 1.0.
Right, which was incredibly heavily reliant on their balance sheet. It was essentially a massive home flipping strategy.
Exactly. And it relied on what the industry calls HPA, or home price appreciation, which basically means your entire business model hinges on the assumption that the housing market will always go up.
Always go up, right.
Yeah.
Which is great until it doesn't.
Exactly. It was capital intensive and, frankly, incredibly risky. Under the 1.0 model, they were acting like a traditional house flipper, just on a massive corporate scale.
So they would just buy a property, take on all the carrying costs, sit on it, and just cross their fingers that local housing prices would keep skyrocketing.
Right. And when interest rates were sitting near zero and home prices were inflating by the month, that looked like an absolute genius strategy. They were making money hand over fist.
But I look at that and think Opendoor 1.0 was basically like a speculator buying physical gold, storing it in a vault somewhere, and just praying the price per ounce goes up.
That is a great way to look at it. And the problem with being a speculator is that as soon as the macroeconomic environment shifts, like when interest rates spike to combat inflation, that reliance on price appreciation becomes a fatal flaw.
Because suddenly the market freezes.
Exactly. It exposed the company to extreme, unpredictable market volatility. Think about it. If home prices dip even slightly, suddenly you are left holding these massive bags of depreciating assets.
And you're paying holding costs on all of them.
Oh, yeah. Taxes, maintenance, insurance, debt interest on thousands of houses that are literally losing value every single day.
It's just a remarkably efficient way to destroy billions of dollars in wealth.
It really is, which is why this 2.0 pivot is so fascinating to watch. The competitive moat they are trying to build now is no longer about having the biggest balance sheet to hoard the most houses.
So what is the new moat?
Well, Opendoor 2.0 is acting more like a stock exchange. They don't want to care if the housing market goes up or down. They just want to facilitate the trade as fast as possible and take a fee for the speed and convenience.
So they're replacing the balance sheet with AI speed.
Precisely. It's AI-driven velocity and what they call capital light distribution. Instead of humans doing the grunt work, they're using AI for automated title intake, proprietary underwriting, even AI-powered repair estimation.
Wait, so the algorithms are instantly analyzing thousands of comparable neighborhood sales to price a home, rather than like an analyst sitting at a desk doing it manually.
Exactly. They are trying to transform from a buyer of last resort into this high-speed, frictionless transaction engine.
Now, let's look at the fundamentals,
Yeah.
because they've completely changed the engine of their business. But I'm struggling to understand the latest numbers here. Let's look at the Q1 2026 financials,
Okay, let's break them down.
because the top line is still contracting violently. Revenue fell 38% year over year, down to $720 million. And even worse, the GAAP net loss actually widened to an intimidating $173 million.
Yeah, those are the headlines that scare people away.
Right. I mean, if the new model is so great, why are they bleeding $173 million in a single quarter?
It is a completely fair question. But you really have to peel back the layers on that net loss. That $173 million figure is a GAAP loss, generally accepted accounting principles.
Which is the official everything included accounting number.
Exactly. But buried inside that $173 million loss is a massive $120 million in stock-based compensation.
Okay, break that down for me. Stock-based compensation. That means they aren't actually writing a check for $120 million out of their bank account, right?
Correct. It is a non-cash expense. In this specific case, it is tied largely to the new CEO's joining package. They gave the incoming leadership a massive amount of stock options to incentivize them to, well, turn the ship around.
Now, it is still a real expense for shareholders, though, right? Because it dilutes the value of existing shares.
Yes, absolutely. It is real dilution, which we will definitely talk about later. But from a purely operational day-to-day survival standpoint, that $120 million did not drain their cash reserves.
So if we strip out that one-time, non-cash executive payday and look at how the actual house flipping machine is running, what does the picture look like?
The picture changes entirely. First off, that's $720 million in revenue. It actually beat Wall Street's consensus of roughly $666 million.
Oh, wow. So they beat expectations.
Right. So while revenue is down compared to last year, it's shrinking much slower than the market feared. Second, their adjusted loss per share was only 5 cents, which beat the estimates calling for a 7-cent loss.
I hear you, but I mean, beating lowered expectations is one thing, actual profitability is another. Though I will concede, looking at these reports, their liquidity position is a literal fortress right now.
It really is. They ended the first quarter with nearly $1 billion in cash and cash equivalents.
And having $1 billion gives you a lot of breathing room.
Oh, that cash fortress is everything.
Oh.
In a high interest rate environment, if you are a turnaround company burning cash, you eventually have to go to the market and beg for a loan at terrible interest rates.
Or issue a ton of new stock, diluting your shareholders to nothing.
Exactly. Having $1 billion gives them a massive runway. They can execute this AI pivot without the existential panic of running out of money next month.
So they have the cash to survive.
Yeah.
But are they actually turning a profit on the houses they buy and sell today? Because if they are losing money on every single transaction, that $1 billion will eventually just vanish.
Well, that brings us to the most important metric for this company, contribution margin.
Okay, explain contribution margin for the listener.
Think of contribution margin as the lifeblood of the business. It answers a very simple question. After we buy a house, fix it, and sell it, did we actually make money on that specific transaction?
Before paying for all the corporate overhead, like software engineers and office leases.
Exactly, the absolute fundamental unit of their business.
Right. If the contribution margin is negative, the whole model is just broken.
Right. And here is the truly bullish signal. Contribution margin bottomed out back in September 2025 during the worst of the housing freeze, but it has improved every single month since.
Wow. Every month.
Yes. They closed Q1 with a 4.4% contribution margin, which is up 3.4 percentage points from the previous quarter. So yes, they are making real money on the unit economics of buying and selling a home again.
And they're doing it while cutting the fat elsewhere. I'm looking at their fixed operating expenses, the corporate overhead we just mentioned, and they've crushed that down to just $33 million.
Which is incredible. That's a drop of $6 million year over year.
But what's crazy to me is that they did this while their acquisition contracts, the number of new homes they actually agreed to buy, doubled to the highest level seen since 2022.
Right, so they are doing way more volume with less overhead. That is the holy grail of tech right there. Tangible, real-world operational leverage. The AI is allowing them to scale up transactions without needing to hire an army of new employees.
So since you brought up scaling transactions, I want to connect this directly to how those margins are actually improving on the ground. Because the biggest risk in real estate, period, is sitting on an unsold house.
Oh, absolutely.
I mean, every day a house sits empty, it eats your margin through property taxes, insurance, and the opportunity cost of tied-up capital.
The industry calls this aged inventory. It's usually defined as a home sitting on the balance sheet for more than 120 days.
Okay. And under the old 1.0 model, how bad did that get?
When the market turned, their aged inventory spiked to an incredibly dangerous 51%.
Wait, 51%? Half their houses were just sitting there.
Just sitting there rotting on the balance sheet. It was an existential threat. But look at what the 2.0 model has done. In just 2 quarters, they slashed that aged inventory from 51% down to just 10%.
That is a massive operational shift.
It really is. To put that in perspective, the broader real estate market's average for aged inventory is sitting around 33% right now. Opendoor's book of homes is materially fresher and moving significantly faster than the traditional market.
Okay, but how did they actually do that? Because you don't just magically sell houses faster in a tough macro environment. How is the AI specifically solving this aged inventory problem?
By completely removing human emotion and ego from the pricing strategy.
Ah, interesting.
Yeah, under the old model or with a traditional seller, if a house isn't selling, there's always a temptation to hold out. I know what I paid for it, and I'm not taking a loss.
Right, everyone thinks their house is worth more than it is.
Exactly. But the AI doesn't care. It monitors real-time buyer foot traffic, comparable closed sales, local liquidity. If the algorithm senses demand shifting, it aggressively and automatically reprices the home to find the clearing price immediately.
So it sacrifices a few $1,000s in potential upside to guarantee the speed of the sale.
Right, preventing the house from ever crossing that 120-day threshold.
It's pricing to clear, treating the house like a highly liquid financial asset rather than, a precious family heirloom. That makes perfect sense. But earlier, you mentioned their moat was capital-light distribution.
Yes.
I have to push back here. Wait, how can a company that literally buys physical houses be capital-light? Yeah, you still have to use millions of dollars to buy the houses, right?
Under the core cash offer business, yes, they absolutely do. But the capital-light narrative comes from their explosive new product lines. This is where they monetize the transaction without ever actually putting the house on their balance sheet.
Okay, how's that work?
Take their cash now, more later product, which literally tripled in volume in Q1. Or look at their partner agent network. Let's say you want to sell your house. You go to Opendoor. Instead of Opendoor buying it with their own cash, their software acts as a marketplace.
So they route the listing.
Exactly. They route your listing to a network of institutional buyers or partner you with a traditional real estate agent. And Opendoor just takes a percentage fee for originating the lead and facilitating the software transaction.
Ah, I see. So they get the margin of a real estate transaction, but they take exactly zero risk on the underlying asset.
Right.
If the housing market crashes the very next day, Opendoor doesn't care because they don't own the house. They just collected a fee for routing the seller to a buyer.
Exactly. And because of this ruthless inventory clearing and the growth of these risk-free products, the company officially hit a massive milestone. As of April 1st, 2026, they achieved 12-month forward adjusted EBITDA profitability.
Okay, for the listener, let's translate that. Adjusted EBITDA profitability. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Basically, it means if you look at their core go-forward business engine stripping out past debts, taxes, and one-time executive stock payouts, the actual machine of buying, routing, and selling houses is finally generating more cash than it consumes.
Right. It proves the 2.0 concept actually works in the real world.
That brings us to the catalyst timeline. What are the actual events over the next few months that could force the rest of the market to wake up and reprice this stock?
Well, we have a clear timeline to watch. First, there's an immediate catalyst. The CEO is presenting at the J.P. Morgan Global Technology, Media, and Communications Conference on Monday, May 18th, 2026.
And this isn't just a standard PR puff piece, right?
Not at all. This is a critical venue for institutional re-education. He needs to stand in front of the biggest fund managers in the world and convince them mathematically that this AI-driven margin model is real and sustainable.
Okay, and after that?
Then the real test comes in August with their Q2 earnings report. Management has laid out very specific guidance. They expect Q2 revenue to grow about 25% quarter over quarter to $900 million.
Okay, that's solid top-line growth.
But more importantly, they guided the contribution margin to hit the middle of their 5 to 7% target range.
So the market will be watching that like a hawk. If they actually hit that 6% margin and maintain that adjusted EBITDA profitability, it proves Q1 wasn't a fluke.
Exactly. It proves the machine is genuinely fixed.
Now let's pivot to the chart. Because technically speaking, looking at the stock chart, it is a mixed bag right now. The stock is currently navigating a very heavy death cross formation.
Yeah, so for those who aren't, like, chart experts, a death cross is when a short-term moving average, usually the 50-day average, crosses below a long-term moving average, like the 200-day.
Right, which mathematically shows that short-term momentum is dragging down the long-term trend.
Exactly. It is traditionally a very bearish signal, a giant red flashing light for technical traders.
So what does market sentiment look like with that death cross hanging over it? Are people bailing?
Actually, no, we are seeing a fascinating shift in market sentiment happening right now. We are seeing a transition from distressed selling people dumping the stock out of fear to what looks like turnaround accumulation.
Meaning institutional money is quietly buying the dip. And there's data to support that, right?
Oh, definitely. After they announced that terrifying $173 million gap loss, the stock didn't crash. It actually traded up nearly 1% to $5.37 following the earnings call. And over the past month, the stock has posted an 8.5% gain, completely outpacing the S&P 500's 8.2% gain over the same period.
And outpacing the broader index while carrying a death cross usually means big money flow is stepping in.
Right. It suggests the market is looking past the gap loss, looking past the old value trap narrative, and starting to price in that forward profitability milestone.
But talk is cheap. The biggest, most glaring bullish signal for sentiment right now isn't coming from Wall Street analysts. It's coming from the insiders themselves.
Yes, this is the detail that really caught my eye. You can manipulate an earnings call narrative, but you cannot fake open market insider buying.
Exactly. CEO Khosrow Najatian and company director just went into the open market and purchased a combined $488,000 worth of shares.
And it is crucial to understand how they acquired those shares. They didn't just receive stock options as part of a compensation package. They took nearly $500,000 of their own personal cash, went into the public market, and bought the stock at current valuations.
That signals absolute conviction. I mean, when the CEO buys $500,000 of stock with his own money, it aligns his financial destiny directly with the shareholders.
It tells the market, I see the internal metrics, I know this AI pivot is working, and I think the stock is deeply undervalued. It's the ultimate vote of confidence.
Now let's talk about the risks. Because if you are listening to this and thinking, wow, an AI real estate turnaround, I need to jump on this, we really need to take a step back and look at what could go wrong.
Yeah, we have to look at the bear case.
We cannot ignore the historical volatility here. This stock has experienced average peak-to-trough declines of 52% across 5 major systemic shocks.
52%. That means it routinely loses half its value during market panics.
Right. That is nearly 4 times the average drawdown of the S&P 500. It is definitely not a stock for the faint of heart. And the dilution risk we brought up earlier is very real.
Yeah, they issued $120 million in stock to management. If they keep issuing massive equity packages to retain talent, the overall pie gets sliced into more and more pieces. Your individual shares become worth a smaller percentage of the company, which really weighs heavily on the stock price over time.
And then there's the macro threat. We talked about how they fixed their inventory, bringing it down to 10%.
Mm.
But what if the housing market completely freezes?
Right, say we get an unexpected spike in unemployment, or the Federal Reserve shocks the market with another massive interest rate hike, sending mortgage rates to 9 or 10%.
Suddenly, no one is buying homes at any price. Even AI can't sell a house if there are literally 0 buyers in the market.
Exactly. And if their inventory ages past 120 days again, all those beautiful contribution margin gains just vanish overnight. The macro environment is the one thing their AI cannot control.
So with everything on the table, what's the final verdict?
Well, based on the stack of research we've gone through today, the analysts assign a bullish score of 7 out of 10 to this turnaround.
So a solid 7 out of 10.
Yes. The fundamental thesis is clear. Opendoor 2.0 is working. They are successfully transforming from a flawed, balance sheet-heavy home flipper into a high-velocity, capital-light, AI-driven transaction engine. And for a multi-year investment view, hitting that adjusted EBITDA profitability milestone is huge.
Right. For anyone studying this space, the takeaway is that the competitive advantage in real estate has officially shifted from who has the most capital to hold assets to who has the best software to move assets.
Exactly.
I want to leave you, the listener, with one final lingering question to ponder on your own. On their latest call, management explicitly noted that they achieved these recent margin improvements, slashed their aged inventory, and hit profitability in a high-rate housing market that, quote, was supposed to break us.
It was supposed to break them and it didn't.
Right. Think about that. If this newly disciplined AI-driven model can stabilize and reach profitability during a terrible macroeconomic environment where mortgage rates are literally suffocating demand, what happens to their velocity and their profit margins when the macro environment actually becomes favorable?
It is a fascinating thought.
And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is Grow $100 to $10K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.